Hey guys, how are you? This is Ishai Breslauer, your host of the CRE SharkEye Show. I hope you guys are doing fantastic. We have a great guest today, Kevin Peranio, and we're going to discuss a lot of stuff that he does in real estate because we speak a lot about commercial real estate of all type of formats, right? But today we have this privilege and the treat to talk about a lot of lending, and we got ourselves educated on that. Kevin, thank you so much for being with us. I really appreciate your time.
Yeah, thank you for having me. I really do appreciate it.
100%. You know, before we dig into your story, which I'm anxious to hear about, let's start with first of all what you do today, like an elevator pitch. What is your company does? What do you guys do today, and how you serve, everybody in the market? Then we're gonna dig in, just like a quick thing.
Sure. So I'm in Southern California. I'm originally from Texas. Been with Paramount Residential Mortgage Group for almost 11 years. The company's been around for just about 20 years. We're privately owned. There's two founders, Paul Rozo and Robert Holliday, and then myself as a partner as of about a little over 5 years ago. And then we have another partner, Gary Malice, who's our capital markets and strategy officer. And we have 2,900 employees, 3 different channels, all focused on residential home mortgages. So we've got a retail channel with about 250 branches around the country, about 1,300 loan officers. We have a wholesale channel serving B2B partners like brokers, wholesale brokers. And then we have a correspondent channel. So if a broker, independent, third-party originator, if they would like to get a warehouse signed and get into lending themselves, we also have a channel to serve them and then serve all of our communities. We sell to Fannie, Freddie, and Ginnie, so we do securitized loans, and we have a portfolio as well. And we're just trying to build our communities and teach financial literacy every day and serve those who served our country and serve the underserved. So it's a very fulfilling mission that we're on every day.
Sounds very fulfilling and also very exciting. And I want to tell those who are in the podcast format and are not viewing it, I want to just describe what you're seeing now. Kevin is in the car because he had to go to the car because his kids are running around in the house. And I wrote him, I love it because, that's life. That's real stuff. That's how life should be.
Kevin,
I just
very nice.
Yeah, go ahead. Go ahead, shoot.
You were very nice to. Okay, no problem. I'll hold off. I get it. And then we get in the car and you're like, oh, by the way, I have 5 kids. I totally get it.
I'll tell you something. You know what? How much of a blessing it is.
It is. It really truly is.
Years ago, I'm a religious Jew, and years ago I was in a synagogue, and came in a very important rabbi to speak, and the kids were running outside the hallways. He came to one of the hall, there's a hall, whatever. He spoke to the congregation, and there was noise from the kids, and he said, you know something, that noise, that is a blessing. That means that there's continuity. That means that there is life, and there's nothing like it. So bless you, man.
Yeah.
I love it.
Yeah, amen to that.
So you're in the car, and life is going on, and everything you do for them. Party time. Exactly. Okay, so I want to ask you this. We're going to dig into all that stuff that you actually do, that you spoke about in a nutshell right now. But, beforehand, now you're a family man. You're a partner in big business. We'll talk about that later. How'd you get into this whole thing? Can you go over your personal story? I'd love to hear that.
Yeah, for sure. So I'm born and raised in Dallas, Texas, and I went to college, University of Texas at Austin, Texas Longhorn. And when I finished my 4 years of school, I guess I just hung around Austin about 5 more years. And in that time, I sold swimming pools for a summer. That was kind of a fun job. So I liked selling swimming pools. I liked talking to people, sitting down at their dinner table and, planning, something fun like building a pool. It's hot in Texas. Awesome. That was fun. But then the summer ended, so I had to find something to do, and Dell Computers was hiring. So I hopped on their call center with a little headset. I would talk to people and help custom build computers for them. That was a lot of fun. Then the price war started, and margin dropped out, and it was kind of hard to make money. And I was kind of used to making a little bit of money, even though I was 23. I might have gotten a little cocky there, but my buddy got into, he was a real estate agent in Austin, and he flipped over to the lending side, and he worked for a company called First Magnus that was privately owned and based out of Tucson. He said, I'm doing this B2B sales account executive role. I call on mortgage brokers around the country, and I try and convince them to send their loan to our lender. And I was like, that sounds really fun. You know, I like numbers, I like people, I like housing, I like the American dream. And once, you know, it's something I tell people, especially when they're introducing their children to me who are in like their, you know, late teens, early 20s, and trying to figure it out. I always say, chase your dreams, do whatever it is you thought you were going to do, doctor, lawyer, athlete, and I hope you make it. But if you don't, only then do you get into the housing industry, because once you get in, you can never leave. And I know almost nobody that's left and stayed gone for the rest of their career. And I've been in ever since. Been since 2001. I've been in lending. Been in 3 different companies. I've had the the blessing to be just kind of work my way up and partner up with some gentlemen that wanted to expand their company, expand their team, and now I live in California. Would have never thought that. I went from Dallas to Austin to Chicago to Tampa to Fort Lauderdale, and now I'm in Newport Beach. And so trying to root down over here.
Amazing story. Tell me something. When we talk about lending, what is your focus today after all these years? You just told us beforehand, but I want to start digging into this whole thing. What type of loans you give to? Is it mostly single family? Is it commercial? Is it for multifamily? Is it individual? Is it what type of? Who are you servicing, you guys?
So we're residential lending, and really in I guess there's 3 ways to break it down in America. You've got residential lending, which basically any single family or duplex, triplex, or 4-unit. Anything over a fourplex is considered multifamily, aka commercial. Although most people, when they say commercial, they think like a strip mall or an office building. But anything 4-unit or more is not residential. And within commercial lending, there is multifamily, which maybe
right.
a 10-unit, 20-unit complex. So we're strictly residential lending and single family. We actually, the main they call them government-sponsored entities, and is Fannie Mae, Freddie Mac, and Ginnie Mae, and pretty much they're like the overseers of all the securitization and the guidelines and making sure everything runs smoothly, which it didn't always run smoothly. I mean, look back at 06, 07, and then 08, and
we're going to talk about that
financial crisis. Yeah. So so for us, we're focused on residential lending, and then our company, we're focused on the originator. So we have a saying, built by originators for originators. So we feel the originators are our client, even our own originators in our retail channel, or originators that own their own mortgage or lending company in our wholesale and correspondent channel. If we serve them, who are the experts, and we make our platform modern and we make their job easier, if we serve them, then the borrowers, consumers, realtors, developers, everyone down the line all gets served as well, because we're held to the highest standard by the originator. So that's our mission. That's who we are as the company.
So I'll tell you what, I'm so happy that you are here with us, and I'll tell you why. Because this is a commercial real estate show, and very rarely I have someone who's coming from the residential aspect of lending, especially lending. And you have no idea how happy I am that you are here, because you just mentioned 2007, 2008, and this is who knows better than you what happened over there. And I really want to dig into that perspective and how things got different. But beforehand, you know what? Let's just simplify it for everybody who's listening. You just mentioned, and I loved what you said. You said anything that is beyond the 4 units, meaning 5 units and above, is already considered commercial. People don't understand that sometimes there's a huge difference from what the bank is demanding from a person who's taking the residential that you're dealing with on a daily basis, as opposed to the commercial stuff. Do you want to go and explain that?
Yeah. Typically, a residential loan is based off an individual borrower or maybe a couple or 2 bars. You can actually, on some loans, go up to 4 people, but it's really rare to have more than 2. But it's just based off, their credit capacity, the collateral, the house itself. Those are things that you're looking at for the individual. So, we're looking at their pay stubs and how much money they make in their tax returns. We're looking at their bank statements and verifying how much assets they have. We look at their credit report, to see if they're credit worthy. And then, of course, we look at the home itself. Is the collateral, the basis of the loan amount, does it appraise? Does it have the value that it says it does, and on the loan application? So in case things go to hell in a handbasket and the borrower can't make their payment, at least the lender or the bank has the collateral. They have the home to back it up. Commercial, much different. It's really based on really just the cash flow of the property itself. I mean, there's a value of the property, and that has to be appraised as well. A commercial appraisal is so much more involved and much more expensive. There's a lot more to it. Obviously, the property's bigger, but does that business cash flow? Does that office building have a certain occupancy and rent roll? What is it that's going on the commercial side to make that stand on its own? And so, where the blindside risk for both of those really is, does the borrower face a hardship, or does the business face a hardship? And if that happens, that's where the lender gets stuck with a loan. And in lending, there's kind of this old adage. It's like, if you have a $100,000 loan, you individually have a problem. If you have $1 million loan, the bank has a problem. And $1 million is a lot of money. It's a lot of money. And if you add up a lot of $1 million loans, or even a lot of $100,000 loans, like back in 2008, you can have a crisis. You can have a financial crisis. And at the end of the day, what we do in both resi and commercial is we buy and sell money. We're buying and selling money. And that's one way to think about it. It's nice here, it's the American dream. You get the house and the yard, and you get to have a barbecue on July 4th. But on the lending side, it's a mortgage-backed security. It is a commercial mortgage, a commercial-backed security. You have this piece of money, this fixed income asset that is backed by a home with a borrower paying it, or backed by a business on the commercial side that cash flows and is a sound business. And so there's a fixed little payment that goes to the bondholder, to the security holder, to the one that bought that money. So it's always been seen as one of the safest and most risk-free assets in the world. And so when there was the crisis like we had in 2008, it was a tectonic shift. I mean, people and countries all over the world, other than buying U.S. Treasuries, one of the biggest fixed income securities markets is mortgage-backed securities. It's a big, big market, and it's supposed to be safe. And so, sometimes, when things go wrong, that buying and selling of money, that gets levered up, it gets, over leveraged, and the way people, and institutional investors, the way they buy things and mark things on their book, if the market shifts and they have to mark those assets to market, and the market's falling, that can have a lot of ripple effects, which we saw that a year ago with the pandemic health crisis, and then obviously we saw it in 2008 with the global financial crisis.
Something, let's dig into that a little bit. I love that the direction that you just took. When we talk about 2008, what I want to do right now is I want to dig into the 2008 aspect and to think about it for a second, and to dwell in it for a second. Meaning, I watched, first of all, everyone who's in real estate and involved, definitely heavily involved in real estate, just like yourself from 2001, knows exactly what happened. And a lot of people are still asking, what exactly happened? What exactly happened? And obviously today, not only movies like The Big Short, it's one of my favorite movies. One of my favorite movies. I watched
the ninja loans. No income, no job, no asset.
I love that. So that's exactly what I want to get into. This whole episode, hey, ninja loan, those two guys were talking. Obviously, it was exaggerated in the movie. They put them
totally
you put them to appear as two idiots, and and people who originate money, people who make sure that you have a loan, and how to say, the brokers, with finance brokers, whatever they are, usually are more sophisticated people, are more responsible people, obviously. But you know what? There was some truth to it, of course, because we know where the market went to. You were in the middle of everything. 2001, if just for the people who are listening, some of the people are very young and some of them are much older. But, and I remember 2001, we all know what happened. The World Trade Center collapsed. We had another crisis, another type of crisis then. But then 2008 was a very unique type of recession. What do you remember from the ins and outs of the daily work that you had, that all of a sudden 2007 came and said, boom? Meaning before the boom, what was so different then that caused it from your perspective, because you were in the middle of it?
I really was. I was living in South Florida. I had a team of 107 people. We ran the biggest office for our lender that was a national lender. And, South Florida was like, to use an analogy, but we were like ground zero for, the housing and mortgage meltdown. There was so much craziness going on, where I was right in the thick of it, and I saw it. So it's interesting. It's a great question. I love the way you phrase it and frame it. I actually did a documentary, a docuseries for Duke, and we had like an hour-long discussion, and I kind of went through these events of the history, because there are many perspectives out there. But let me just, regardless of what you heard or what you think, let me just set the record straight. Again, housing is buying and selling money, and there are groups or institutions that set the rules and the regulations and the guidelines. And overwhelmingly, those companies that had the rules and the regulations and the guidelines, starting all the way back, with the Community Reinvestment Act from the 90s, which basically said banks must serve underserved markets and zip codes. And that meant adding risk. If you're going to put someone in a home that maybe isn't the best credit worthy borrower, that inherently is a risk that they might not pay. And so that it was kind of the open framework to say, okay, let's try to take more risk. And so that evolved. Remember, loan officers on the ground, lenders on the ground, even, they didn't make the guidelines. Fannie Mae and Freddie Mac blessed the guidelines for conventional loans. They bought the securities. They helped clear the securities.
Yes.
And a lot of Wall Street and the larger banks, would create risky products that, they said, well, hey, based on homes appreciating up and forever, that even if a loan defaults, maybe more than 1.5% or 2%, maybe loans defaulted, 3 or 4%. That's okay, because if loans are going to appreciate, let's just say 5%, houses appreciate 5% every year. That's okay. We could take the ones that default, and then we'll just remarket and we'll take our losses because we made gains, on the greater number, and we're all good. But where that ended up is there was a loan that was called a no doc loan. So you would literally fill out the loan application. You would put your name and your social security number, okay? And the social security number is how you would run your credit. Your credit score just had to be 620 or higher. Now, in lending, 620 is considered A paper. It goes all the way up, beyond 800. But 619 is subprime, okay? So 620 is A paper. So then they had this whole section of guidelines and loans called alternative A, alt A credit. So this no doc loan was like, we've got this borrow the 620 credit score. And because home prices will continue to appreciate, we're going to allow them on this no doc loan to leave their job blank, leave their income blank, and leave the assets on the application blank. So all you did was get their name, their social security number, run their credit. You can see their credit profile. They may have never owned a credit card in their life, but here's $417,000. Go buy a house. That literally was how easy it was to get a home
But
in
tell me something.
2006, 2005, 2006, 2007.
You know, this is crazy. Just let
So,
me stop you because
here's $417,000.
it's crazy. Let me 1 second, back up. Let's do it step by step, okay? Because this is exciting. Let me ask you this, meaning exciting in a bad way, but exciting. So here's my question. You're in the middle of this whole thing, and you're running loans. I'm assuming that, you know, back in the past was more similar to what it is today. And it became more like you just said, you know, fill out the thing, everything blank, and so on. I'm not going to repeat what you said. But what was the point when you saw that all of a sudden they say, okay, now you can do this, and you started probably scratching your head and you say, yeah, are they crazy? What was that point? Can you tell us about what you felt and what you went through when you saw those requirements?
Sure. So, you know, there are all kinds of different types of loans. You know, one was a no ratio where, you know, you put the person's, you know, the income is blank, and then you could see their debts. And then if they had a lot of debt, a lot of payments, you know, people could, like, the underwriters who worked on our team could reverse engineer, and they basically would say, I know I'm not supposed to compute the ratio, but I'm good at simple math. This person can't afford this house. And I remember one time very vividly, kind of in early 07, where, you know, this loan was denied, and one of my salespeople and the broker who we got it from, they're like, it meets guidelines. Why aren't you doing it? Why are you reverse engineering no ratios? It's a no ratio. And the underwriter is like, this borrower can't make this payment. And so, you know, I felt like I had to back up my underwriter, you know, because I could just see it in that this person has been in the industry 10, 20 years. They know when a loan's good or not. And they're telling me this loan is not good. So, you know, you start to get some rumblings there in early 07, spring of 07. Then there was this website called the Mortgage Lender Implodometer. So there were lenders where loans were going bad. And when loans go bad and they default, whoever bought the loan goes back to the original lender, says, hey, you need to pay me for the loss. Well, they couldn't afford it. I mean, these lenders are doing, you know, billions of dollars in loans. They don't have billions of dollars in money. Everything was over leveraged, right? And so when loans started to not perform, then Wall Street and the banks, Fannie, Freddie, Ginnie, you know, the GSEs, they started to redo their math and go, okay, the default ratios are a little higher than we thought. So we're going to do away with the no-doc loan. Okay, now we're doing away with everything under 620 credit score. Okay, and then everything was like, it was like a contagion, right? And so I remember I was on a trip to Italy. I had just bought a yacht, okay? Wow. I just got engaged in Sicily to my my girlfriend at the time, fiance, and I got back, and it was the very first week of June of 07. It was my first paycheck on June 5th where I did not bonus. And I'm like, what's going on? And I had loan losses. So we had losses coming back that our investors were sending to my company at the time, First Magnus. And I was like, oh man, this isn't good. And then 2 months later in August, we were in Maui celebrating our president's, our column club is what we called it. So it's like our incentive trip for all the top performers. And I remember walking down the path to breakfast, and all my sales managers, they're always top producers. They're sitting on this balcony super early right after breakfast. And they're like, hey, did you hear that ABC Mortgage went out of business? Now they're owned by a REIT that was called American Homefront. Billions and billions of dollars in assets out of business. And I remember they said, what's going to happen? And I remember saying, this is in August of 07. I remember saying, our industry has a long, long, long way to go before we find the bottom. And the next week when we got back, we were shut down just like that. And it just happened so fast. It happened so fast in that summer of 07.
What do you mean shut down?
And, you know, our lender with over 5,000 employees, First Madness at the time, literally went out of business overnight.
That's crazy.
So I had to go into my office and talk to 107 employees, look them all in the face. And I was upset. I was, visibly emotional. I was like, I'm sorry, we're no longer in business. This is all of your last day. And, but I did it face to face. I think that was the right thing to do. And it was hard. And it happened systematically in our industry because what was going on in the secondary market, remember the buying and selling of money, those loans, for example, the Alt-A loans, they were rated by the ratings agencies to be less than A paper credit. And so we had, let's just say, $750 million in loans on our warehouse lines. And, basically the company had to pay $150 million overnight to business. And they weren't able to do it. And so they just said, you know what, we're just going to, file bankruptcy and get out. And that was basically, that was how it went. I mean, it was just like that. And it's just amazing to see, go ahead.
I just wanted to ask it's a crazy story. Obviously we all know it, but hearing it from the inside from you, what happened to you? Meaning, okay, you had to, you closed up shop, and then what? What happened? You probably were, I don't want to know what happened, but if you could share with us a little bit of what you went through at the time, rethinking everything, how was that?
Yeah, of course. Yeah, I mean, I bought a freaking, boat 2 months earlier. I had to give it back to the bank. I made basically 10% of my income, I 90% income, overnight. So I started, I just went through a lot that year. I broke up with my fiance.
Wow.
We didn't get along under the same roof with all that stress and pressure. And obviously it's a blessing. My wife now is just like 1,000 times, over amazing and a blessing to our family. But I found a small lender and in Deerfield Beach. It was actually owned by two Israeli gentlemen, and they were very small, and they mostly focused their business on buying and flipping properties on the side. So they never really paid a lot of attention to the lending side that they had. They're a very small lender. So I said, you know what? I know lending. My team and I knows lending. We're going to come in. And what I felt was they didn't have any baggage from the past, and that was good. So we could start fresh and start, at a new lender while all these lenders were crumbling. Literally every lender of any size went out of business pretty much, unless it got bailed out as a bank by the United States government, by Treasury. So I had my 107 staff, and I found my top 33 people. I found them jobs within 2 weeks. So we're in the middle of this recession where people are getting laid off right and left. There's no jobs. No one's growing, not just in housing, but really any industry, because it really kicked off a huge, it was called the Great Recession. It was a real recession. And I was able to take 33 people and get them jobs in within 2 weeks. And I felt like it was the right time, because, people are still buying houses and doing refinances. A year later, rates came down. So, it was a nice little refi boom there when the Fed stepped in and did all the stimulus. So, I found a home for us right away, and they made me up their partner. And so I got to learn the ownership side of the business, running a business, not just running the front end services operation. And in 3 years there, when I worked with that team, we really had a good, I like to say I got an MBA in mortgage banking and lending. And, but unfortunately those guys did have baggage from the past. A lot of the homes that they owned, a lot of the property that they owned, obviously lost value being right there in South Florida. And they didn't have the capital requirements to stay in business, which, since then, our industry is totally different. There's no fake loans like that anymore. The capital requirements to be a lender are enormous. You have to have a lot of cash. There's a lot of regulators that look at you all the time and are always watching you. There's no blanks on the loan application. Everything is filled out and verified with the bank, with your employer, with the IRS for your income.
it's a totally different world now. I mean, there's no bubble whatsoever, when it comes to the lending side. So it was good for me to get that education. And then I met, with Paul and Robert about 11 years ago. And, they were trying to expand from California to the East Coast. And I was like, I'm the right person for the job. I have a whole team of experienced people and would love to partner up with good people. And because of what I went through, with those first two companies, I asked these guys some tough questions. How much cash do you have? What's your balance sheet like? What's your net worth? Do you service? How do you reserve for losses? When you have losses, what did you do? Has any investor cut you off? Like all those kinds of things. And these guys are like, you're asking a lot of questions. We just want you to help run our East Coast. But I didn't want to step into some pitfall. I wanted my people that I brought who followed me and trust me to know that I took them to a place that could benefit their families for a career. So anyway, it was a great move for all of us. And here I am almost 11 years later with the same company, moved to California, and they made me their partner. So I really have seen it from, the peak down to the Great Recession and then all the way through another couple cycles. And it's been an exciting 20-year career.
It's amazing because you've been in the whole thing. But you know what? I think the mind-boggling part of it is meaning what happened to you is on a personal level is crazy. It's crazy. And some of the people are actually went through this now in COVID. But I'm saying, I think the mind-boggling part of the whole thing is the fact that the banking system on the larger scale, on the Lehman scale, on the, those guys, they have made such a mess for everybody because I don't know who made those decisions. How could they make those decisions? How could they make those decisions at the time? It's just crazy. I can't believe that. I want to shift gears a little bit to what's going on today.
Amazing. We know it was amazing.
Market today. So thank you for this. Market today. Okay, we spoke a little bit about this right before we started. Obviously, it's not the same environment, especially lending environment, and you are the expert. But the market is crazy hot, especially in the single-family home section, also multifamily section. But I think that the pandemic pushed a lot of people out of the urban, the cities, the California, the Los Angeles, obviously the New York City, etc., Chicago, to run out to Nashville, to Idaho, to Florida. Florida is a big deal, and to go into the suburban areas. But in general, what do you see? What do you think is going on in the market with the supply, with the lending environment, with everything together today, which is a completely different setting? But what is going on? Where are we going with this, especially after COVID?
So there's a few factors happening. The single biggest factor is we have a wave of demographics that are bringing demand in home buyers on the market. So the average first-time home buyer is let's just say 33. So millennials make up the single largest home buying demographic in America. The number of people that turn 33 each year gets larger and larger for the next couple of years. I think 5 years. I think there's a total of 9 years where those people that turn 33, the number of people that turn that age is larger and larger. So you're in this household formation age where people get married and they want to have kids and they want to go buy something and own something. And so that's the single biggest factor. The second is a massive housing shortage, massive. And I'm going to talk about something that's very underreported. So here's the thing. In the decade from 2010 to 2020, or 2020, there are about 5 million units short of what normally was built in pretty much any decade on history and housing. The main reason why: builders did not get bailed out by the U.S. government. So when all the banks got, like you mentioned, Lehman Brothers, they didn't get bailed out. AIG got bailed out. Bank of America, all the banks, all the money center banks got bailed out by the government. Builders did not. Now, the way that builders used to build is they would build like 20 or 30 homes and then go sell them. But then when the Great Recession happened, nobody was buying the new homes, and they were stuck with all these houses just sitting out there, and they had to work through all that. So now the way builders operate is they sell the home based on what it's going to look like, get somebody on the hook, then
On
start
paper.
building the home. Yeah. And so so now when this wave of demographics is hitting, there's just not enough housing builders, there's not enough home builders, there's not enough people to go, if you want to go buy a new home, you just can't. And so the flip side of that wave of first-time home buyer demographics is baby boomers are staying in their houses, they're living longer, they're not selling. There's good home health care, better than selling and going to a nursing home. Now you have home hospice and home care. The HECM mortgage, home equity conversion mortgage, you may have heard of as reverse mortgage. That's a financial product for anyone basically now 62 years and older.
Yes.
Where you just pay off your mortgage, you don't have a payment, no more payment for the rest of your life. So there's no need to downsize and sell. You can get cash out. So there's a lot of factors that are coming into play. And of course, we have historically low interest rates. But typically for purchases, rate doesn't matter. I mean, if you're going to buy a house, you're going to pay the rate. It could be 5, it could be 4, it could be 3. It doesn't matter. So,
Right. And
so
add to all that, the issue for builders that the lumber prices are just skyrocketing.
Yeah, so that's interesting you bring that up. They were as high as I think like $1,700. They call it like 1,000-foot board. That's like the commodity price. That actually has come down in the last 45 days by over half. So
that's insane. I didn't even pay attention to that.
So that's not even an issue anymore. The Fed was calling some of this transitory, right? Like, okay, the cost of lumber is going to come back down. Well, yeah, these sawmills that were shut down during the recession or the last couple of years, they're firing back up again. They're like, hey, let's make some wood, because let's chop some wood because the housing industry needs it. And so now it's back to where it was. Same thing with copper and aluminum and steel. You got China that just hoards all this product and then dumps it on the market. They created the commodities price. So some of that inflationary pressure
That's good news.
was in fact transitory.
These are good news, actually. These are positive news.
It is. But there's some inflationary pressures that we're all watching that, when the Fed puts trillions and trillions of dollars in the economy and increases the money supply, that could have maybe a longer term inflationary effect. That's something that everyone's kind of watching, the second half of this year. Wage inflation, here right now, there are 9.2 million jobs open, and there's about 8.5 million people looking for jobs. There are more job openings than there are people that report that they're looking for a job. There may actually be maybe 11 million people looking for jobs, kind of like there's part-time lookers, there's different ways it's classified. But the bottom line is there's a lot of jobs out there, and people aren't rushing to take the first job, the first, waiting tables job they see. They're holding off. And so there's actually a labor shortage, which has created a little bit of wage inflation. And one thing about wage inflation is that, if they hire someone at a higher wage, they typically don't then later cut down that person's wage. So,
right.
So that wage inflation, that cost of producing goods, even if it's a service industry, that's a pressure on the bottom line for corporate profits. That is an inflationary pressure, which is not transitory. That typically stays. So there are a couple factors that, on the macro we're looking at, but that's also, if the wage inflation is because of a growing economy, that's a good type of inflation. So that's a good inflation.
Right. That's correct. You know what? Moving ahead towards where we are right now, towards the future. I know you didn't bring your crystal ball when you left those 3 kids running around the house, but I'm going to ask you anyways, because that's my favorite question, basically. what do you think? Meaning, what do you think is going to happen in the next year, housing wise? Is there any break that we're going to get? Prices are going to, meaning, is there any correction that we're going to look at? Some people are talking about those doomsday guys are talking about something collapse that is going to happen. Some people are talking about the prices are going to skyrocket and you should buy now. What is your take on all those calls from everyone?
Well, I think a lot of that is typically those individuals calling for that, looking inward, and just that's their view and their prism of how they see the world, right? And so some people are very conservative, and that's a defense mechanism. They don't want to be caught by a bubble or by a crash, and so they're saying that because just in case it happens, they don't want to get caught up. I mean, a broken clock is still right twice a day. So but as far as right now in the short term, there is no housing bubble. We have a massive housing shortage. We do not have supply. We have historically low interest rates, and we have a wave of demographic for people that want to come buy houses. We have a real supply issue. Now, where this could correct is that inflation could slow. Interest rates could rise, and if anyone is disheartened, they may leave looking for a home, and that would decrease the demand. I don't think that decrease in demand with higher interest rates is enough to offset the shortage of housing supply, but I think it'll work itself out here over the next couple of years. But let me just say this for those that are saying, well, should I buy now? If you're renting, the answer is absolutely yes. If you're renting, you are paying 100% interest rate to a landlord and making that landlord rich. So you have to have a secure roof over your head. You might as well do it where you're getting all the wealth and equity. So if you can buy a home, you should always go do it, regardless of what's going on in the market from a macro factor. But if you are fearful of that macro factor, I will just say that right now is probably the most Goldilocks moment we've had in housing. We don't even have our 9 million jobs filled yet. Imagine when those jobs start to get full and we're back to 3% unemployment or less. This economy will be booming. And that's great for housing, and that's great for house appreciation. So, we're still kind of in that transition from recession to boom growth. And housing gets stronger. Behind the scenes, there's no crappy loans. There's not a bunch of bad loans waiting to wreck this economy. I mean, these borrowers that went into forbearance, there's about 2 million borrowers still in forbearance that, lost their job. They're getting free subsidy. Basically, their principal and interest is being paid by their lender for 12 to 18 months for free, just by verbally saying, I experienced a hardship through COVID-19. They're gaining home price appreciation. So once they have to come back onto the market, these 2 million borrowers, most of them overwhelmingly have been resuming their payments. But if they can't find a job, they can't simply just restart their payment or do loan modification, they could sell their house. They all have equity. And the housing supply is needed. I think homes are selling in 1 to 4 weeks on average. That's crazy. So
it is.
Yeah, we're in a very good spot. I'm a huge advocate of home ownership, versus renting, and most people that have any kind of wealth in their life, they've done it through real estate. So I'm such a fan of it, long term. It's not like anyone that's listening to us is just not going to go live under a roof and just go live in the streets. Maybe there are some people that want to live off the grid, but home ownership is the most secure thing you can do for you personally and financially. So I just think now is always the time.
So first of all, right, but obviously some people have different perspective on that, but I love your perspective. I love the perspective of what the market is going through right now, and especially when you are in the middle of everything and you get those guys who are actually buying homes coming to you, and you've been through everything from 2001. So that qualifies you as a guy that we need to listen to, and everybody needs to listen to. So I like that. Kevin, before we say goodbye, tell everybody where they can find you. How can they, get to you, and so you can give them service?
Yeah, just find me on LinkedIn.
Obviously, we're going to have the links above, below. Don't worry about it. But I'm saying, if you could tell us.
Yeah. You can find me at a trade show or a conference pretty much half the year trying to figure out what's going on. But yeah, I'm on LinkedIn. Just hit me up on LinkedIn. That's where I put out video content a couple times a week. I try and give relevant, fresh information kind of mixed in with what's going on in the markets. And, that's where, I try as a servant leader, I try not to be self-serving. I really truly like to build a community within LinkedIn, and like how you're doing with your podcasting. I mean, I love it. It's let's all share ideas and talk and have dialogue and understand what we're all going through, so we can just make all of our lives a better place to be. So that's it. Find me on LinkedIn and let's build our communities together.
Amazing. Kevin, thank you so much. Thank you so much. You guys, check out, I hope you enjoyed this, because I have enjoyed this. Check out the links above, below, all over how to find Kevin. And you can find him on LinkedIn, as he said. And Kevin, thank you so much again. Thank you for being with us. I appreciate it.
No, thank you, Misha. I appreciate it. I really, truly appreciate it.
Awesome. I had a very good time. And you guys, I'll see you in the next show. Take care.